a lot of my clients in this sub $5 million space kind of use the bank as a green light for them.
I always say they don't use this as a form of due diligence.
I'm thinking, from the bank's perspective, there's this moment, right, where before you miss a payment, you should be talking to your bank.
They always ask, well, what's the reason? Why do people default? And I always say it usually starts with the deal.
When does the government get involved if there's a default?
When the loan reaches 90 days or greater and goes towards the charge-off element.
You do your own taxes?
I do not do my own taxes.
Welcome to DealMakers, where we get to the truth behind all of the buying boring business clickbait. My guest today is Shannon Hay. Everyone in my industry knows Shannon Hay. Shannon, welcome. Please explain who you are, in addition to everyone's best friend in buying accounting businesses.
Well, yeah, look, we want to help everyone accomplish their goals, and I think today's episode is going to be special towards that, knowing it, who I am. Let me do that. So yeah, Shannon Hay, SBA lender, nation's largest accredited SBA lender for the NAICS codes of accounting and tax preparation, payroll, and bookkeeping. Do more loans in that industry than any other lender out there.
Yeah, I mean, that's true. And the thing I always like to point out, which is maybe making your life a little bit better and a little bit worse, is you give everyone your cell phone number.
So I will today at the end of the call. You know what I
Yeah,
will.
we'll put it in the show
You
notes,
want me to do it
but
now?
everyone knows. Yeah, we'll put it in the show notes. Don't worry. Everyone, blow up Shannon's phone because he does. He's very accessible, responsive, and he's really the first person to identify the niche market that I got to experience as a lawyer. You really were the one to say, there's not a lawyer doing only this, and we would really like one. Uh,
Yes.
that brought this hyper niche focus that I have to light. I wanted to talk to you today because, well, we talk all the time about all the deals that we're doing, but
Yes.
also because I get a question that people don't always feel comfortable asking their
Yeah.
banker
Of
directly sometimes, which is,
course.
what happens if the deal goes bad? They're taking on a
Yeah.
big loan. People generally go into debt for things like their house
Yes.
or their car, right? And I think
Yes.
the car is the easiest one because you're going, I'm going to buy a car, I'm going to have these payments, and everyone knows what it means to have them repossessed, like repoed, you're getting
Yeah.
your car,
Yeah.
you're behind on payments, somebody comes and takes the car back.
Yeah.
And so, similarly in the mortgage crisis, a lot of people who are my age, a lot of my clients right now are, late 30s, 40s. They were young professionals during the 2008 mortgage crisis, like I was. And so they know that people, the bank can come and take your house if
Yes.
you miss your mortgage payment. But
Yes.
it's not as clear to them what happens to them if they take out a big 7A loan and they
Yeah.
default on it. And
Yes.
that's a weird thing to ask the person you're trying to get to give you the loan.
Yeah.
So,
It's never a question you really want to ask while you're in underwriting or trying to get approved. The banker will always want to know, why do you want to know the answer to that question? I do speak to it a lot because of positions, like you're talking about mortgage positions, right? Because that becomes relative to any 7A that's greater than a half a million. You have to pledge any asset greater than 25%, meaning, but it generally encumbers real estate, right? Personal residence, any rental properties. When there's a 25% equity position or greater, the bank has to take a position on that. And so I have to explain what that looks like to the borrower or buyer during that process. So that conversation, that's about the only time it really comes up, I would say.
okay. Well, yeah, it comes up more to me. So
Oh,
people are
sure.
like, have you seen this happen? And on some occasions, after, well, most often before the loan, because what we do, just to plug it, everybody apparently needs to buy an accounting practice because it doesn't happen often in this space. You're usually buying a cash flowing business, and by virtue of getting the 7A loan, you have a certain debt service coverage ratio that is allowed, like they've projected forward and made
Right.
sure that you are
Yes.
likely able to make a living
Yep.
and pay the debt loan or the debt
Yes.
service payments. And
Yes.
that's valuable. Like, I think that a lot of my clients in this sub $5 million space kind of use the bank as a green light
Form
for
of-
them.
Yeah.
Yeah,
Well, I always say they don't use this as a form of due diligence, right? Where
exactly.
a lot of people think that we are, but the SBA requires two forms of due diligence from the SBA lender themselves, and that is third-party transcripts. So we're always going to verify what the seller provides and confirm that they filed that directly with the IRS and that those numbers aren't different than what they actually provided during the sales process. And then a third-party evaluation, which, like a house appraisal, is kind of driving towards the needs of the lender. Um,
That's such a nice way to put that.
I think, well, I got to be careful on that one, right? Um, SBA evaluators are designed to evaluate to the loan amount, like very
Right.
much mortgage. They're designed to evaluate to the purchase price.
Yes.
And so that has actually been a hot topic of conversation right now, is that the third party evaluators aren't really catching up with what I say is the current market.
Yeah, because private equity has juiced the market. The multiples are getting up there, and it's. I mean, what I'm seeing a little bit is regular buyers who are looking at bank financing are kind of falling behind. It's harder to keep up when every attractive deal that's listed really doesn't meet that 7A criteria, but you've got lots of big financial buyers who can come in with all cash or whatever their approach is, their family fund or what
Yeah.
have you.
Well,
So
so I like to say is they're buying opportunity, or they're buying what they believe are their projected revenues, and our individual buyers are buying, and what 7A is based on is historical revenue. So we're not looking forward like PE is. We're looking backwards to confirm that what we're getting ready to talk about doesn't really happen, right? That's the goal, is to prevent the D, right? Default.
yeah.
Yeah. So what happens? Look, we're not owner operators, right? I'm not a CPA. I'm not an accountant. I'm not a tax professional. I do not want to claim to know how to do those things.
You do your own taxes?
I do not do my own taxes. No,
Me
I do not.
neither. People ask
I,
me that every day, and I'm like, "Are you
yeah,
crazy?
yeah,
Absolutely
no
not. I
way.
barely
No,
look at
there's
my
no
own
way.
bank balance." So,
Yeah, no, there's no way. I would never do that. I would never do that. Mostly because I don't want the liability of it, right?
yeah,
Very similar to the bank is not going to want the liability of what comes with managing accounting clients, right? You have to be a CPA in most states, greater than 51% ownership to own a CPA firm, right? If you're filing taxes, you're probably an enrolled agent, hopefully, at least, at minimum. Accreditations that aren't held by bankers, right? Or what I would call special assets officers, right? So those are the guys at the bank that are in charge of figuring out what to do when you do default. Now you're personally guaranteed, right? So the first place the bank's always going to look is what do you have, right? What's your liquidity? What's your cash? And that's going to be an examination of all that. And then all those considerations are going to come into play as to how the bank responds. First and foremost, the bank's always going to want to try to work something out, right? They want to create a new payment arrangement, figure out what the current cash flow is, try to help you self-solve. Sometimes they won't come and have that conversation. I would say that's a conversation you probably should try to be forcing to have. In other words, if you know you're missing payments, pick up the phone and talk to your bank. I was a special asset officer for 15 years at Bank of America and did distressed dental, medical, and veterinarian practices. So I'm
interesting.
very close to seeing the bad side of the equation, right? And again, bankers aren't dentists, vets, or doctors, right? So to have a veterinarian practice in our possession is not something we would know what to do with very well. There were times though where someone was forced to walk away for whatever reason, or I have a whole list here of what I say are the D's, right? So we're talking about the big word D, default, right? But they always ask, well, what's the reason? Why do people default? And I always say it usually starts with a D, right?
Death,
Debt,
divorce.
divorce, drugs, depression, disability.
There we go.
Uh, yeah, and the list goes on, and it feels like everything kind of falls in that D category.
That's
So don't get a
interesting.
D, get an A. Just kidding. Um, so, you know, the bank is going to want to try to get you to the right side of the cash flow equation so that you can continue and start making your payments again. They want to keep you in operation. If you're not having those conversations, they're going to assume that you don't want to cooperate. So
Yeah.
they're going to do what they have to do. If you're not talking to them, then they have to hire a lawyer, right?
Mhm.
They have to then engage legally. They have to try to obtain judgment on their liens, right? And so because with those judgments then allow for them to make those legal positions. And maybe I'm jumping ahead a little bit or getting too
No,
fast into the game.
I'm thinking, from the bank's perspective, there's this moment, right, where before you miss a payment, you should be talking to your bank. I think that's definitely a bright line moment. But a lot of folks are looking down the pike thinking, oh gosh, the things I'm doing to make my payments are getting increasingly challenging. And I'm
Yes.
not sure what's going to happen on a go forward basis. So for those
Correct.
folks, I'm hopeful that this is helpful information for them because they're trying to figure out what happens if like I do miss a payment, but they don't want to
Yeah.
tell the bank necessarily yet because they're still working out their other things. Maybe there's a house they could sell or a family loan
Yeah.
or something that they could
Yeah.
take on.
But I would say your bank still wants to know that, right? So
Right.
if that's your solution to your problem, the bank would love to be aware of that because then they can then because the lack of communication is what creates the decision, right? And more communication allows for a more educated decision, and the bank's going to try to make educated decisions on their positions.
Okay.
Now they are using historical like experience, so they go through this process much more frequently than you do.
Right.
So I would choose words carefully, choose solutions carefully. Um,
Tell me about that.
yeah, so if you don't have a solution for how you're going to fix the overarching problem that's causing the inability for you to make the payment, and you can't present that to the bank, then as a lender, I'm in you put me in an emergency situation. Like we had a terminology, that dog don't hunt kind of thing, where you just if you've taken over the business and you've proven that you can't manage it, it's going to be hard to convince the bank that you should continue to. And so the bank's then going to say, how do I maximize the return on my investment, or how do I get as much back from this as quickly as possible? And they're going to likely want to cooperate with you on a sale, right? Push you towards a distressed sale.
Right.
If you can't make a payment, they're going to, and look, this are goodwill assets mostly, right? It was the same in dental and veterinary and medical. There's not a lot of value in the assets of those businesses. It's mostly the goodwill of the business. The recurring revenue of the client is really where the value lies. And so to preserve that is going to be in everyone's best interest. To keep that revenue coming in is going to be in everyone's best interest. And so they want to ensure that that's possible.
If there's a default looming or existing
Hmm.
and the bank says we really, think you ought to sell, they're so are they doing that at the same time that they're seizing those other assets, your house, your bank accounts, whatever
Yeah,
you
so seize is a really hard word, right?
That's fair, yeah.
Yeah, it sounds very like I don't know, like
Draconian, yeah.
yeah, yeah. So
Medieval.
again, that's where the communication lies. That I feel like they're only going to take those actions if you're not talking to them, right? So, or if they have to see something too, right? So they have to see the equity in the house, they have to see the cash in the bank, and if they see those things or recognize those things, then they'll move to do so. If they think you're not communicating truthfully and that you're trying to hide those things as you're going to, run away, right? If you have a big position available in a house and you know it's there and you have like this large amount of equity and you know the bank has the position on it, you should be saying, "Hey, I know that's there. You know that's there. We both know that's there. How are we going to resolve that?" Right?
Yeah.
Because the bank, again, it's going to cost them to sue you, right? It's going to cost them to then send somebody to reappraise the home, figure out what the first mortgage is. They would have to, if they're a second mortgage position, they have to pay the first mortgage off to be able to have the first lien position to be able to move towards forcing you to sell. So most of the time, the bank's going to say, "What's the distress value of that?" So, like, let's say you think it's $1.2 million property, the bank's going to say it's worth $1 million, and then they're going to say, "Well, maybe it'll sell for 750, and our position is 250. Let's negotiate on that 250, right?" And that
Right.
that is where that communication again, they're going to come after that 250 if you're not going to talk about it. But if you're going to say, "Hey, I know the 250 is there, let's make an arrangement on it," they're likely going to do that because the cost to get to that 250 is, could cost them 50, which if they can avoid that and still, negotiate something fair and reasonable with you, that could mean going out and getting another loan, a first mortgage for all of it, right? Whatever that
Yep.
amount could possibly be, and then taking that difference and paying down that secondary position.
So interesting. So there must be a whole slew of lawyers who focus on helping people navigate this type of process.
100%. Most of them
Okay.
are bankruptcy attorneys.
Yeah.
Yeah. And I always say, and the bank's going to love me for this one, is talk to your bank before you talk to your bankruptcy attorney.
Okay.
But it's just like a divorce lawyer, right? You're not going to go to them for marriage advice, right? You do not.
Oh, that's so good.
Do not go to your bankruptcy attorney for financial advice, because guess where they make their money? When you
Yeah.
file bankruptcy, right? They don't make money if you don't.
Yeah.
And it's not always the end all be all best solution to every problem.
That is true. I've seen just a couple of bankruptcies, on the sidelines. I'm by no means a bankruptcy attorney, but I partner with
Yeah.
them when my clients are going through it.
Yeah.
And it didn't go in any event the way anyone hoped. But like to your point, when you're a hammer, everything's a nail, right? So
Yeah.
you you're
Yeah.
predisposing yourself to your solution if you talk to a bankruptcy attorney, just the same
Exactly.
way that, you're more likely to get a collaboration. So that's helpful. They're going to work with you if you talk to
Yes.
them. Let's
Every bank should, if they're, it's in their best interest to do so.
That makes sense. When does the government get involved if there's a default?
So when the loan reaches 90 days or greater and goes towards the charge off element, it has to physically charge off before the bank can turn to the government and ask for their guarantee. So and the bank does have to prove to the SBA that they made a reasonable attempt to try to collect the debt as it was occurring. And so you would have hopefully had those conversations well before that ever happened. It basically is a documentation scenario for the bank, right? So when we go back to the federal government and say, can you know, honor the guarantee, there's a file, right? And it's probably, it's not just it's not a piece of paper or just a, request. It's a file, and it's going to talk about all the historical, especially for PLP lenders, right? Because we're not going to the SBA to get the approval in the first place. We're approving it based on our own underwriting standards that we've cleared with the SBA.
Right.
And so it really
The
is
preferred
almost
lender program.
correct.
PLP.
Correct. Yes.
So,
Sorry. Preferred
yeah,
lender.
I'm always pushing clients. I mean, I don't have a dog in the fight, right? Other than I want deals to get closed because people don't
Yes.
like paying their legal fees for nothing that like didn't go through. They still have to.
Right. Yeah. Me
So
too.
sometimes they don't. But the preferred lenders are much more likely, in my experience, to get to closing. And I mean, way faster because you don't have to send it off to the government to underwrite.
That's
So,
that's correct. That's correct. Yeah. And so
um,
if you had sent it off to the government to underwrite prior, maybe if you were asking for that guarantee in a default situation, it probably wouldn't be, the file would maybe be a little thinner because because we're having to tell the story from beginning to end, right?
I see what
Where
you
it's
mean.
already been, maybe it's, halfway through anyway. So
So, how many of these happen?
great question. So I have the privilege of crossing the 400 mark this year, of accounting firms financed, and I can't count on my fingers how many deals that have went bad in my knowledge, right? So now that's gonna, every deal that gets declined now they're gonna be like, well, you've had less than 10 fail out of 400. It's like, yeah, but we're in accounting for a reason, right? We're dealing with professional CPA professionals for a reason, because we do hope that because of that accreditation that they're a lower default rate than a
Right.
non, right? But so I really would, rather than try to nail down a specific number, it's low, right? It's much less than a 1% default ratio on on the portfolios I've created. The story though is really always the same on or similar, right? On what those failures look like, right? And so this is kind of my flashlight moment to the industry, is that these, the non accountant owner operators, right? These investor types, the ones that want to manage a deal in Florida from Colorado, um, you know, um, in other words, long distance management, absentee management. This is a professional. It's like, if I wanted to buy a law firm, I probably would want to know a little bit. I probably should know a little bit about law, right? I mean, because if it comes down to it and someone's got to do the work, finding that solution can sometimes be difficult. And so, why I say it's a flashlight to them is the failures that I've seen are all relative to owner operator, right? Meaning that something in that owner operator variable caused the default issue. Let me talk about that. Employee control, right? So as an owner operator and as someone in there physically doing the work, you're interacting with the employees on a daily basis, but you're also interacting with the clients on a daily basis. Well,
Mhm.
a lot of these firms, like especially these investor types, right? Who's interacting with the clients? It's not the owner, right? It's
Yeah.
not you as the new owner. That's the reason why it's so appealing to you, is because I don't have to do that, right? It's the employees. Well, I've seen some employees pull some major coup d'etats after the closing, right? It's, how dare you not sell it to me? How dare you sell it to so and so? We're just going to go down the street and open up our own accounting office. And guess what? Who has the list? Who's been talking to ABC dry cleaners down the block for the last 5 years? They have, right? And so very easy for them to just maneuver, and they're not under typically the stringent non-compete restrictive covenants that the seller is, right? So
Well,
especially in niche type businesses, right, where these employees are dealing with those clients more on a niche level, right? So if it's like, for example, I had one that went really sideways, and it was expats, right? They were doing taxes for expats, and all of the staff was doing tax returns for expats, and all the relationships with the staff on those expat returns were with those employees. The buyer came in, also was an expat expert, seller was an expat expert, but then the employees just got, man, they didn't. The buyer bought it and then never showed up at the office. And so
yeah.
was trying to manage it from home, was trying to like have this, new relationship with these employees. Well, they're all in the office, right? And so they get off a Teams call and the employees are going, well, excuse me, I don't want to say, I want to use bad language, but they're like, screw that person kind of thing, right? Where, why would you, what's our loyalty to them? All they did was pay a bunch of money to John, who we loved, and now he's gone. And so we know these clients more than anyone. It doesn't make any sense for us to do it for them, for them to make all the money.
And yeah, I exactly that. And it's so funny that you point that out because that's a theme. And I've been told from some brokers too, that is the one red flag if they have a seller, especially you kind of skated past it a little bit. But if they have a seller, they say, did any of your employees want to buy this business? And if the
Yes.
answer is yes, then it's
Yes.
going to be a really impossible, very challenging transition to a
Yes.
new buyer. But
Correct.
also, I have a lot of experience back in the day in med spas, and that's such a big weakness in the industry
Yeah.
because people have a relationship with the person that they're
Yes.
interfacing with,
Of
and
course.
that's like whether it's your injector or your
Yeah.
bookkeeper, like that's your person. A lot of
Right.
times in the med spa industry, they're texting the people. They don't
Yeah.
care at all. They never interact with the owner. They don't care about
Yeah.
the owner. They don't care
Right.
about the name on their invoice. They
No.
just care about the person that they're interfacing with. So if your employee
Yeah.
leaves, and from a legal perspective, because I'm a lawyer, right? Your non-competes are way less enforceable against employees. If you're a buyer coming in and you never even get a chance to hire the seller
Yeah.
employees, they're not going to
Yeah.
be under any obligations to you whatsoever.
Yes.
Um,
Yes.
so it can get really sticky. That's a really good point. Being remote, being a financial buyer. Also, you're expecting your employees, like I'm a business owner, right? And expecting your employees to run a business like a business owner when they are employees, I don't understand how that could ever pan out.
So another one of my failure stories, a gentleman he was in a high profile position at a university, and wanted to buy a practice, tax and accounting practice, was going to get out of the university, treadmill or whatever. As he bought the business, as he's leaving, they of course want to make him president of the entire university, right? So it's like, no, what did you to be president of it all? And he's like, well, president, shit, I never knew that I could be president. And he's like, well, I got to take that job, right? But I bought
Okay.
this firm over here. Still, it's done. I was going to put my notice in. I already bought it. Tries to manage it with the new employees.
Yeah.
It 6 months. They didn't make it. I mean, you can't be both. You can't you can't be president of a university and then run a $1 million accounting firm. It just doesn't.
Yeah.
It just
Successfully. Okay. That's a
yeah.
really
So
good example.
yeah,
It,
fast transitions, right?
yeah.
Where like a buyer buys it and says, I'm going to be there in 2 weeks. And then it takes them 6 weeks to get there. And then in that 30 days, the seller's like, where you at? I'm not going to work this. You
Yeah.
already bought it. I already sold it to you. It's your job. And then they fail to, failure to launch is really what I kind of call that one, where it's
I
just like
do. I've seen
you
that
buy
too.
the, you buy the business and you don't take it over. Like
It's the weirdest thing. I warn my sellers of that because I've had that call a year later and I go, "Hey, how's it going? How you liking retirement?" And they're like, "Well, the buyer has never shown up. Nobody's doing any of the work. I'm still doing everything. I'm keeping the money, which is fine, but I can't sell it again. How am I supposed to get out of this?"
right.
It's
They're
like a
trapped
worst
on the
case
hamster wheel the
scenario.
buyer created for them. Yeah.
Yeah, and unless they're willing to
Unbelievable.
just like walk away and let all of their clients just like really struggle, which usually they're not, because that's a really hard thing. They don't really have any opportunity to get out anymore. So,
Well, I'll remind everyone that you're not buying a piece of equipment. You're not buying manufacturing machinery, right? So it's not as if you're pushing a button and letting off the button and the money prints, right? This is a relationship business, right? It's called goodwill for a reason. And if you're not in a position where you're gung ho to transition goodwill, you're not in the right industry. You
Yeah.
have to control the values and the goodwill. That the machine, the manufacturing machine that prints the money, is the people and the relationships. So
Yeah.
you need to be able to manage the people and the relationships. Oil it, fix it, put it in. Do all the things, right? So surprising to me, honestly.
What else do you see that leads to default or charge off?
Again, I go back to too much too fast, or trying to do too much too fast. Not thinking that you can pull off a transition in 30 days or less with a 30-year relationship. What's your average transition time in most of the documents you see nowadays?
I
What's
mean,
the
minimum six
expectation?
weeks, right?
Right, right.
Well, what I do is minimum 6 weeks.
6 weeks to 40 hours a week, right?
Right.
So you're
And
okay.
then just availability for the first year.
Right.
Because, the example I always give is it's the night before tax season and you've gotten logged out of your software and it's sending a two-factor authentication to the former owner's cell phone. Like, you need it to get somebody who can
Yes.
respond to you for
Yes.
the first year
Yes.
at least. Even if they're on their Alaskan cruise or like living their best life, at least from 9 to 5, Monday through Friday for the first year, they should be relatively responsive.
Yeah. Well, I would say Mrs. Jones, your $1 billion estate client, comes in for her 2013 tax return, and it's stuffed under some file cabinet in the back office because it's never got converted digitally.
Yeah.
You have no idea where that's at. No way you're ever going to find it. It's not even in the system, right?
Yeah.
But that seller knows where he put it back in 2013.
That's true.
That's a pretty important phone call to pick up to be able to know where Mrs. Jones's 2013 is, right? So.
Although, like, why does she need it? That's so long
I
ago.
don't know. I know.
I know.
Maybe it's a bad analogy, but it's really more about goodwill transition availability, because a question is going to come up from something that the seller knows that you're was never privy to. It is in the
Yeah.
back of the seller's head somewhere. You got to be able to go access that data.
I like my sellers in a perfect world. Like, if I can make my own deal for a buyer, I want the seller to have had a full year where knew they were going to try to sell. And I tell them, like, during your tax season, everything you do, you've got to think next year somebody else is going to be doing this. So, whether it's, training your clients to not drop off a box full of receipts or whatever.
Receipts. Yeah.
Yeah. Or it's, making notes in their file because you realize, hey, I actually decided 10 years ago, we had this long discussion. We decided to do X this way, and it's not immediately apparent why. So, we're going to make notes and
Yes.
describe it. So if you could touch every client you have for a year with the idea that the next year somebody else is going to be doing it, you have a great practice to sell. But if you
Yes.
haven't been doing that, I don't think it's reasonable for you as a seller to say, like, peace, sayonara, like, I'm out of
No,
here.
no. Well, I would say there should be. Well, this could be for the sellers too, whether they care or not that their businesses fail after someone buys them. That's up to them. But I would say that part of your responsibility in your sale is the transition of that goodwill,
Yeah.
and that's what you're selling. You're selling that to them.
Yeah.
It's not a here's the keys. Again, it's if that was the case, it would be here's the keys to the machine that prints the money,
Yeah.
right? But that's not what this is. So
That's,
and that's where structure matters, right? How do we have some seller skin in the game? Do they have some reason or some logic as to why they need to participate in that transition?
yeah.
That's another thing where I think private equity might be amiss here, and they're going to probably bump their head on it a little bit. Seller captures their cash, but I also maybe that's private equity's money move, right? Is that they're locking the seller into that future equity event.
That's true.
Um,
Yeah.
so it's maybe that's where the reassurance comes for them, is that I only gave you 60% of your money up front or 70% of your money up front on my, you know, purchase or whatever. You know what I'm
Yeah.
saying?
At this inflated multiple. Not inflated
Yeah.
in a bad
Thank
way.
you.
Just
Hi,
a big multiple.
yeah. Higher multiple. Yes, correct.
Higher
It comes with it.
multiple.
Well, it requires the seller to run through that gauntlet,
Yeah.
right?
Yeah.
And forces them to do so. So I would say private buyer, what are you doing to do that?
That's yeah. When it's not a 7A context, right? And anytime I'm trying to align incentives, I'm saying like, let's carrot and
Yeah.
stick. You
Yeah.
want somebody to be motivated by the fear of a bad thing happening. And I prefer personally, just because my personality type, the goal of something good happening is a lot more
Yes.
like good feelings for
Of
the
course.
relationship. So, but with a 7A loan, seller can't participate in upside after the fact. So, I have less carrot and a little more stick on the retention adjustment concept of a seller note. But, the principle remains like it's important to align incentives because some people aren't going to care. But that also explains why you as a seller can't wait until you have no more gas in the tank to list your firm for
No, that's right.
sale.
No,
Like
it's so
you've got
true. I
to
mean,
transition it. That might be the hardest year you've worked.
well,
So,
and it's going to take a lot of energy. I mean, it
yeah.
should if done right.
Yeah.
And I would want to be sure that you're in that place mentally to do so, physically even. I mean, that's the thing with a lot of these older firms is that the sellers wait to a point where they're way past retirement to even try to make this transition, and
Yeah.
it's like I said, it's not a hand the keys off moment. It's just not how it works.
N-
So
Not in this industry. So, final advice for people who are taking out a loan. I think I mean, it's irresponsible if they're not saying what happens if I default. Like they
no,
need to be thinking it through.
yeah, yeah. Well, you could go to the black and white of the contracts, right, and say the bank doesn't have to talk to you. You don't make your payment. They come for judgment. Again, I want to reiterate your personal guarantee is just as good as pledging any asset. So once you're PG'd, just I don't great. You got away with not having to pledge the equity in your house. You still did. Maybe a lawyer can attest to what the banker's saying, but as if you default, they're going to move towards a judgment. The judgment is going to go towards a lien, towards everything else. The only way to stop that is to communicate with your bank and make an arrangement or file bankruptcy. So if you're not going to communicate, your other solution is the other one because the stuff's coming no matter what, right? It's for the bank. It's 90 days this happens, at 120 days this happens, 150 days this happens, right? So as you edge in that delinquency, there's things they have to do per their policies. So
Yeah, that's the thing that, I sometimes tell my clients not every personal guarantee is equal, right? And
yeah,
because if you've personally guaranteed some to a bank that has that kind of mechanism in place, like they're coming after you. If you make a personal guarantee to the seller of the business, they've got to go find a lawyer, they've got to figure out how to do all this
yeah,
stuff to
they don't
collect
have a
on it.
process for that, right?
They don't
The bank
have a
definitely
team of
does.
special assets, scary people,
Yes,
you know.
correct. Yeah.
So
So,
it yeah.
big final advice, avoid the D's. Avoid the debt, avoid the death, avoid the disability, avoid the drugs, avoid the divorce,
And like
avoid the depression.
consistent with that, the best defense is a good offense, right? So
Yes.
like you got to get
Yes.
in there and get in front of it. So
Yes.
I
Yeah,
think that's
communicate.
yeah, it makes a lot of sense. I like the one other thing that I would probably tell, and I do tell when I'm talking to clients, is like don't get cute. Like there's not only this is only in your name, and this is in a trust, a revocable living trust. Like they'll
Yes.
never know. Like
Yeah.
it's been done. Like every
Right.
weird thing to
Avoid.
do has been done
Yes.
and you can't get cute. You can't, like, for instance, you mentioned it earlier, but like hide how much your home is worth. Like
Yeah.
all of that will sour things so
It,
much
it,
more than it will ever help you, and it's a waste of time and attorney's fees usually to try
yeah.
to do something like that. Like that
Well,
being
I
said,
tell you, coming
yeah,
from that experience, having somebody that cooperates and communicates, the way you treat that person compared to somebody that's trying to maneuver and trying to manipulate,
yeah,
um, it's two totally different strategies from a bank's perspective. So
yeah.
they're using it against you in a good way or a bad way.
Do you think, have you ever seen people do anything creative with their marital assets? Like, because that's something that I get told people are planning a lot is like, okay, well, this is going to be in my wife's name. And, we could always just get divorced if we needed to, which seems like a
Well,
real,
see, Yeah, it to me all it's to me that's the same as a bankruptcy kind of thing. Like you're going to go get a divorce, but you're not going to get a bankruptcy. I no, there's not. So if I don't have your spouse as a guarantee and say they have a trust with their family, like that's an angle that I can't get to, right? That's a personal trust with so it's like they get money from their relatives to support their lifestyle, right? A bank probably wouldn't have any angle on that whatsoever. But if you own a home, with your spouse, that's why at the guarantee table, we're going to say, we're going to need a partial guarantee from your spouse for the equity interest in your home. We're clarifying that before we ever close the loan. If you do a deal less than 500,000 and your spouse owns half the home, that might be a different story. You know, it, I don't try to get spouses as guarantors. I try to make them stand on their own merit and their own borrower,
Right.
meaning the owner, operator, accountant. But when it's close or when it's tight, or when you have a high when you have a high debt to income need, right?
Yeah.
As a family, we're going to bring that spouse along. So if you had a doctor and a lawyer, it's going to be hard to like not want the lawyer to join the doctor in their endeavors.
Yeah.
Um,
You're gesturing at me because I'm a lawyer, not a doctor, though. My husband is.
yes, no, exactly.
Look at
Yes.
me. I'm a doctor and a lawyer.
No, I'm just
Uh,
saying if I was, if we,
yeah.
yeah. So
That's
yeah.
well,
Most
so
of the time your spouse isn't at risk is what I would say.
yeah,
Um,
but you
and
can't
the
get
banks
too
aren't looking.
cute with it.
Never. Yeah. Well, and that's going to be obvious anyway.
Yeah.
You can't hide that stuff.
What do you think about this? Just one more thing I get asked is like, okay, so I have this loan, I've got this personal guarantee. Now we're buying new assets, like things are going good, but the loan is 10 years long. So you've got life to live and assets to accumulate in the meantime. And so future assets, people think it's an easy answer. Like, well, if you personally guaranteed it, it doesn't matter when you got the asset. That's like under the purview of what something that the bank could take. But if they're acquiring all of their future assets in their spouse's name because they're wanting to make sure that they're not going to, be subject to that personal guarantee, does that work sometimes for people, or would it
Yeah.
theoretically?
I don't think the examination would come to that level unless you were doing it in the moment. Like if you were
Yeah,
taking cash off the balance sheet and buying assets for your spouse, that's where the red flag would come into play. But
like
if
as
you
you were
did
also defaulting. Yeah,
correct. Yeah. So all of a sudden, 100,000 disappears from the balance sheet, and your spouse
yeah,
happens to be driving a paid off BMW. That
yeah,
the banks, yeah, again, but they're going to ask that question whether it's today or whether it's in court 6 months from now,
right.
right? They're not going to forget that $100,000 just disappeared off the balance sheet.
Yeah,
It's
that's interesting.
they're monitoring the financials of the business, and I guess if you were, if those weren't legitimate, right? But bank statements tell that truth too. So you don't even necessarily have to depend on your P&L and balance sheet to do so.
Yeah,
And these
and
guys are good. These
yeah.
guys are good. The special assets guys are good. That's their job. That's all they do all day, every day, right? Kind of like
That's
all I
exactly
do all
what's so
day.
scary. Yeah.
Yes, yes. So it should. I mean, yeah, it should be because they're pros at getting the bank's money back.
Yeah,
That's so
that's literally their job, their career,
that's their job.
vocation.
That's their career. Yes, I spent 15 years doing it. So
That's wild.
they're
I bet
they're
you were too
commissioned too.
nice.
Believe it or not, they're commissioned.
What? They're paid on a commission of what they like get back from people? That's fantastic. Ooh,
Now you
I
know.
think I get it. There should be a
Now
show
you
where
know.
you just have special assets going through.
Yes, I know. Yes, yes, there should.
That's so interesting. Okay, so
Yeah.
their
They're
motivation is
incentivized
yeah.
solve, right?
Yeah.
But you don't get the most through forcing someone into bankruptcy. You get the most from getting them to work through paying back as much of the debt as they possibly can.
I mean, yeah, as a former litigator, right? Like everything settles because most of the time people don't
Yes.
roll the dice of a lawsuit, and they certainly don't want to spend the money to get there if there's,
No.
bird in the hand versus two in the bush.
Yes.
So,
Yes.
this has been really helpful. Thank you, Shannon.
Thanks. My
Shannon,
pleasure.
United Midwest Savings Bank, and where can people find you?
Always on LinkedIn. I'm on Twitter at Shay SBA, and my cell phone is 614-648-9199. My email is Shay, SHAY, at umwsb.com.
Love it. Or you can reach out to me. I'll put you in contact with Shannon immediately. And if you found this content valuable, please like and subscribe to it.